Welcome to my channel. I'm Scott. In this video, I'm going to walk you through the process of valuing Dell's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 90 billion market cap. They're trading at 128 a share and they have 700 million shares outstanding. Dell operates through two segments, ISG, Infrastructure Solutions Group, and CSG, Client Solutions Group. The ISG segment provides modern and traditional storage solutions, including all-flash arrays, scale-out file, object platforms, hyper-converged infrastructure, and software-defined storage. They also have AI-optimized servers, and they offer networking products and services. The CSG segment provides desktops, workstations, notebooks, displays, docking stations, keyboards, mice, webcams, and audio devices. It is involved in cybersecurity to prevent security breaches, detect malicious activity, respond rapidly when a security breach occurs, and identify emerging threats. At the end of last year, they sold VMware to Broadcom for $69 billion. The company was founded in 1984, headquartered in Round Rock, Texas. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Lots of free cash flow in 2022, $7.5 billion, dropping 93% into 2023, $560 million. Up almost 1,000% to $5.9 billion in 24, down 43% to $3.4 billion in the trailing 12 months. Talk about a roller coaster ride. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went from $5.6 billion to $4 billion. Really low margins for a tech company, 2 to 5%. Revenue is sales for the company, and that goes down from $101 billion to $92 billion. Not a good trend. They do pay a dividend of 1.4%. and they can cover that dividend nearly 3 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $130 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $116 billion. We divide that by 700 million shares. And we get a calculated stock price of 165. They're trading at 128, so they're trading at a 23% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 33 companies in the same industry as Dell, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx by far, $2.7 billion. We can't look at their debt to equity ratio, negative equity. That means their liabilities are higher than their assets on their balance sheet. They're one of the few companies that pays a dividend 1.4%. HPQ pays the most at 3%. The other companies that pay a dividend are NetApp, Seagate, and Logitech. They generate a lot of free cash flow, second to HPQ. They rank second in market cap, behind Arista. We can't look at their price to book, negative equity. They're trading at 23 times earnings. So their market cap is 23 times their earnings. Price to free cash flow is 27 at the average. Price to sales is 1, which means their revenue is equal to their market cap. And the reason they're behind Arista is because they're not growing anymore. Their 5-year annual revenue growth rate is 0%. Arista is 22%. Nano Dimension is number 1 at 55%. If you put $10,000 into Dell 10 years ago, you'd have $180,000 today. That's a 34% annual return, 1,700% total return. Amazing growth. To summarize, I have them trading at a 23% discount, ranking 8 out of 10. Would I buy at 9 out of 10? I think they're poised to take off with the AI boom. Ratio is 4 out of 10, not so great. Financials 5 out of 10. It should be a little lower because their free cash flow is down 55% since 2021, and revenue is down. But they still have a ton of revenue. They're maintaining it, so they gave them a 5. Let's look at their latest 10Q. Here's their income statement. This is the 3 months ending 8/2/2024, the 3 months ending 8/4/2023. These two columns are the trailing 6 months. Revenue of $25 billion, up from $23 billion, so they're finally moving up. $19 billion is product revenue, $6 billion is services. Let's see if they give a further breakdown. Of the $25 billion of revenue, $12 billion is ISG, Infrastructure Solutions Group, $12 billion is Client Solutions Group. So it's about 50-50. They break down ISG into servers and networking, $7.7 billion, storage, $4 billion. That's how you get to $11.6 billion. ISG is up a lot. It went from $8.5 billion to $11.6 billion. CSG is down. Commercial CSG is almost identical to last year, but consumer is down quite a bit from $2.4 billion to $1.9 billion. Why is consumer down so much? CSG includes offerings designed for commercial and consumer customers. It includes PCs, notebooks, desktops, and workstations, branded peripherals, and third-party software and peripherals. CSG also includes service offerings such as configuration, support and deployment, and warranties. ISG includes modern and traditional storage solutions, including all-flash arrays, scale-out file, object platforms, hyper-converged infrastructure, and software-defined storage. The server portfolio includes high-performance general-purpose AI-optimized servers. Their networking portfolio includes wide area network infrastructure, data center, and edge networking switches. Also cables and optics. ISG offers software, peripherals, and services, including consulting and support and deployment. Products makes up 75% of their revenue. That's up 12% from last year. Services is 1/4 of their revenue, up only 1% from last year. Total revenue is up 9%. Their margins for products are 15%. The other 85% goes towards expenses. Services, much higher margins, 40%. Too bad services is not up that much, only up 1%, because that's where most of their margin is. Their gross margin, the sum of products and services, is $5.3 billion or 21%. Operating expenses are $4 billion. Operating income, $1.3 billion, which is 5% of their revenue, up 15% from last year. Net income, 3.4% of their revenue. That's their net income margin, up 85%. Big improvement. They're not growing revenue that much, but they're lowering expenses. That's pretty impressive. Let's go back to their regular income statement. Let's look at their operating expenses. SG&A, $3.2 billion. That's down from $3.5 billion. I wonder if they explain why it's down. SG&A is 13% of their revenue, down 9% from last year. The decline was due to a decrease in employee compensation and benefits due to decline in overall headcount. So they laid off employees. That's why SG&A is down. R&D is 3.1% of their revenue. That's up 11%, $700 million to $780 million. R&D increased 11%, mainly due to an increase in R&D related employee compensation and benefits. And they're buying back a lot of stock. Last year, $726 million, now $708 million. 18 million shares down. That's about a 2.5% decline in shares. They have 16 million dilutive equity awards. It is possible the employees will earn those rewards and the share count will go up, possibly going up to 724 million. Let's look at the balance sheet. Total assets, $83 billion. Current assets, $38 billion. Up from $36 billion. Current liabilities, $52 billion. So current ratio well below 1. That's a little concerning. They may need to take on debt to cover their current liabilities. They have $5 billion of cash. That's down from $7 billion. A lot in accounts receivable is $11 billion. This is how much money is owed to them when they sell on credit. Short-term financing receivables, $5 billion. That's also owed to them. $6 billion of inventory. Manufacturing companies break down their inventory into 3 stages. Materials, $4.3 billion. Work in process, $700 million. Finished goods, $900 million. Inventory is up a lot from last year. This implies there's lots of demand for their products. You have other current assets, $11 billion. Let's look at their non-current assets. PP&E, $6 billion. Here's a breakdown of the $6 billion of PP&E. $5.1 billion in assets in a customer contract. $3.7 billion in computer and equipment. $2.8 billion in land and buildings. Internal software, $2.4 billion. That sums to $14 billion. They depreciated $7.7 billion. So $14 billion minus $7.7 billion is $6.3 billion. You have long-term investments, $1.3 billion. Long-term financing receivables, $6.1 billion. This is what's owed to them beyond 12 months. Goodwill is their biggest asset, $20 billion. $15 billion of goodwill is acquisitions from infrastructure solutions. $4.2 billion of goodwill is acquisitions of client solutions. Here's a list of some of the Dell acquisitions. $341 million acquisition in 1999 for data storage. NetSage, $10 million. ASAP Software, $340 million. Message One, $155 million. Compellant, $1 billion. $1 billion. They manufacture data storage systems that provide block-level storage resources to small and medium-sized IT infrastructures. They acquired Secure Networks for $600 million, Force 10, $700 million. EMC, $67 billion. That was in 2015. EMC sells data storage, information security, virtualization, analytics, cloud computing, and many other products. They did trade under ticker EMC. Now they're part of Dell. Cloudify for $100 million. That was last year. They have a stake in these 4 companies, and they divested these 3 companies. Divesting is similar to selling, except divesting is getting rid of a business unit to focus more on your core competency. Then we have intangible assets, $5.4 billion. They give a breakdown of the $5.4 billion. Customer relationships, $1.9 billion. It was $17 billion. They amortized $15 billion, so the net value is $1.8 billion. Developed technology, $400 million. $9.5 billion, amortized $9.1 billion. Now it's down to $400 million. And trade names is $33 million. Then you have other for $6.4 billion. Total liabilities, $86 billion, up from $84 billion. Their biggest liability is accounts payable. This is how much money they owe when they buy on credit. They have a lot of deferred revenue, $15 billion. This is when you receive cash for a product or service before you deliver it. Their deferred revenue consists of support and deployment services, software maintenance, training, SaaS, and undelivered hardware and professional services, consisting of installations and consulting engagements. They have $15 billion of short-term deferred revenue, $13 billion of long-term, and they have $18 billion of long-term debt. Here's a breakdown of long-term debt. $15 billion of senior notes, $1 billion of legacy notes. They have $9 billion of DFS debt, Dell Financial Services. So they do have a lot of debt that's short-term, $7 billion. $18 billion long-term, so $7 billion is due within 12 months. So they may need to add some new debt to pay down the old debt. This year they issued $1 billion of debt at 5.4%. That's due in 2034. The money was used to pay down 6% senior notes due in 2026. They also repaid $1 billion of 4% debt that was due this year. Assets minus liabilities equals equity. Negative $3 billion of equity. They raised $9 billion from selling their business, selling stock. They bought back $7 billion of their own stock. Treasury stock is a contra equity account, and they have a deficit of $3.5 billion. Accumulated deficit is the sum of all their prior net incomes minus the sum of the dividends they paid out. Accumulated other comprehensive loss are unrealized losses. We could find out what that represents. Some of that is related to foreign currency translation adjustments and cash flow hedges. That's definitely in this period. In prior periods, it may include pensions as well. I know that's part of accumulated other comprehensive income or loss. Let's look at the statement of cash flows. This is for the trailing 6 months. Operating cash flow is $2.4 billion. It was $5 billion, so it's down a lot. And that's mainly due to accounts receivables. It was positive $2 billion last year, and this year it's negative $2.2 billion. So last year they received payment from selling to customers on credit. This year they had a big cash outflow. Probably in the next statement of cash flows, you'll see a big inflow in accounts receivables. Same thing with inventory. Last year they sold $1 billion of inventory, so that's a cash inflow. This year they purchased $2.5 billion of inventory. That's a cash outflow. They did have a big improvement in accounts payable. They bought $1.4 billion last year. This year they bought nearly $5 billion on credit. That's a cash inflow when you buy it on credit. When you pay for your accounts payable, it's a cash outflow in that accounting period. In their investing section, they had $1.3 billion in CapEx. So they had a cash outflow of $1 billion in their investing section. Financing, a lot going on. They paid back $6.4 billion of debt. They added $5 billion of debt. They bought back $1.4 billion of their own stock, almost triple last year of $500 million. They spent $535 million of taxes on employee stock and $650 million of dividends. This section, they talk a little more about the statement of cash flows. Here's operating cash flow, positive $2.4 billion, investing, negative $1 billion, financing, negative $4 billion. In operating activities, cash inflow of $2.4 billion, driven by profitability, offset by working capital dynamics due to our growth in AI-optimized server offerings. They had a cash outflow of $1 billion in investing. Investing consists of cash used to fund CapEx for PP&E, inclusive of equipment under DFS operating leases and equipment used to support our as-a-service offerings. I think they're missing a word. I think it should say software as-a-service offerings. Additional activities may include capitalized software development costs, acquisitions and divestitures, and the maturities, sales, and purchases of investments. Financing consists of proceeds and repayments of debt and return of capital to shareholders. Repurchasing common stock, inclusive of payments to settle employee tax withholdings on SBC, and the payment of quarterly dividends. Let's look at Dell on Simply Wall Street. Its last price, $128, $90 billion market cap, up 6% in the past week, up 88% in the past year. Here's an interesting article. Dell Technologies expands Dell AI Factory with new PowerEdge servers to accelerate enterprise AI adoption. They're going to be able to offer enhanced AI capabilities, including greater scalability and flexibility, to stay competitive in the evolving technology landscape. New Dell PowerEdge servers drive demanding AI workloads at scale. Simply Wall Street is real bullish on this one. They're at $169 a share. They say they're 24% undervalued. Let's go behind the curtain and look at their DCF model. The discount rate isn't that low, it's 8%. They usually have a lower discount rate. They always use a perpetual growth rate of 2.5%, same as me. And they forecast free cash flows for the next 10 years. So 2025 forecast is $5.2 billion. That's the average forecast from 7 analysts, discounted back to today's dollars, $4.8 billion. And then they go up 10 years to 2034, $7.9 billion. Discounted back to today is $3.7 billion. So cash flows over the next 10 years, $49 billion. Terminal value is $149 billion. The PV of the terminal value is $70 billion. Total equity, $119 billion, divided by 702 million shares, gives you the stock price at $169. 23 analysts priced this stock at $146. They also say it's undervalued. Here's their revenue since 2014. It was $56 billion, and then it came down to $51 billion in 2016. It grew a lot from that point, doubling from $51 billion to $107 billion. That was the peak. The 12 months ending July 2022. Came down to $88 billion, but it's coming back up. It's currently $92 billion. The big concern with Dell is all that debt. It was $17 billion in 2014. It ballooned up to $56 billion. They did a lot of acquisitions. The peak was $57 billion, but they cut that in half to $25 billion. I think the sale of VMware helped. Equity is always lower than their debt. Currently, they have negative equity, negative $2.8 billion. That means their liabilities are $2.8 billion more than their assets. They have some cash on the balance sheet, $4.6 billion. That's enough to service the debt. Their ex-dividend date is 10/21. X means without dividend, so you need to own the stock before 10/21 to get the 10/31 dividend. Their yield was much higher, up to 3.5% in April 2023, but the stock has come up a lot, so the yield is coming down to 1.5%. The forecast is 1.7% by 2027. The CEO's salary was $950,000 in 2018. It came down to $255,000 in 2021, back up to $950,000. Michael Dell is a CEO. Tenure is 11 years. I think it's been a little longer than that. Total compensation, $3 million. He sold a lot of stock, $361 million of stock. I know at one point he was in the top 10 in richest people in the world. On September 10th, he sold 3 million shares at $106 per share. That was 16% of his holdings at the time. In the last 3 months, he made an even bigger sell at $761 million. In the past 12 months, he sold $2.5 billion of his own company's stock. In the past year, lots of insider selling, mostly by Dell himself. He sold 10 million shares on 9/25, 10 million on 9/22, 1.2 million, 4 million, 3.4 million. Silver Lake sold 1 million. Silver Lake bought 1.3 million. Dell sold 2.8 million, 5.7 million, 1.5 million. He sold another 3 million, 1.3 million, 2 million. Some of those sales were for a few $100 million. 50 million shares were sold by insiders in the past 12 months. 46% of the companies owned by insiders, 31% by institutions, 14% by the general public, and 9.5% by VC and private equity firms. Dell is still the biggest shareholder at 46%. Next biggest is Silver Lake Technology. That's a private equity firm in Menlo Park. Vanguard owns 2.5%, BlackRock 2.2%, Fidelity 2%. You have UBS 0.5%, Amundi 0.38%. Deca Investment, you know it's a German company because it has GmbH after the name. Invesco 0.3%. Aspects Management, a Hong Kong firm. Employee count was 98,000 in 2015, up to 165,000 in 2020. Lots of layoffs, laying off 40,000 people. Now they have 120,000. And the ticker trades on the New York Stock Exchange, Wiener Börse, Mexican Bolsa, Börse München, Deutsche Börse, Xetra, London Stock Exchange, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.